As fantastic a CFP as Mello is, and as wonderful an attorney as I am, please do note that anything said in our show are our opinions alone and are not meant to be taken as financial or legal advice.
Welcome to Finances, the Other F Word, a Gen Xer podcast for musicians and music lovers, where we discuss money and music without all the pretentious bullshit. Here are your hosts, Zoe Terry, attorney at large, and Mel O, certified financial planner and author of Finances, the Other F Word. Listener discretion is advised.
I am back on this glorious Friday. I hope all of you guys are having a wonderful day and will have a wonderful weekend. I have been absent on AMP for a while because I've just been trying to get all my shit straight, but I will be back hard and heavy and returning to check out all you guys' shows, of course, see what's happened since Android has went live, because I have not really been in the app since then, and go from there. But today on Money and Metal, we are talking about a couple things. We're going to talk about the downgrade to the U.S. treasuries and does it mean anything at all, and what does it mean and how does it affect you. Then we're going to talk a little bit about the housing market and what the current interest rates are, and are there potential fixes of the housing market. Now, a lot of these are just ideas that I'm talking about and following through, so that we can see that even though none of them are the perfect answer to the housing market, they are solutions that are there. And then on the tail end of that, I'm going to talk about an article that I read that many of you might have read yourself, which is fucking fascinating, talking about mail order houses. And this is something that was around way before us. So for those of you who are new to listening to the show, my name is Mel O. I'm a certified financial planner, licensed financial advisor. My investment company is Hot Moon Financial. My podcast is Finance is the Other F Word. My book is Finance is the Other F Word, Another F Word to Love. And this is Money and Metal. And that, of course, was Fool in the Rain by Led Zeppelin, which for 100 years, I had no idea what the name of that fucking song was, by the way. Yes, and Munster, I could not find you on the day of your birthday. Dude, I kept trying to go into every chat room and tell you happy birthday. So yes, happy belated birthday. Trash was first. We got Analog coming in second. CPL, what's going on, babe? How are you doing? Good to have you back. I'm interested for your insight on the Treasury downgrade as I go through it, because I know you're going to be familiar with what I'm talking about. Turd, what's going on? I haven't seen you for a while, babe. Super Kitty, good to see you as well. So let's talk a little bit about what happened. Well, there was two things that happened. Last Wednesday, Powell did his, based on what he told us, his last, I'm air quoting, his last interest rate hike for the year so far. And the reason why I say that is because every time Powell has said, and so for those of you who don't know, Jerome Powell is the Fed chair. He was appointed to the Fed by Obama, but he was made Fed chair by Trump. Okay. So Jerome Powell, he is in charge of monetary policy that within, as far as like money supply and things like that. We've talked about interest rates on the Feds and everything, but he told us at the very beginning of the year that he was going to raise interest rates by 3 times by 0.25% before October. And he did. He did. So last Wednesday, that was his third 0.25% interest hike. Now, will he chill out on the interest rate hikes? Who knows, right? We don't know. We don't know what he's going to do. It depends on what he's going to see. We still have developing issues out of Russia and Ukraine, which I've covered on this show multiple times. So there's a lot of things that are going on. They're still trying to keep an eye on inflation to see if it's been tamed enough. And then we had some job indicators that came out that were a little bit confusing. But the thing with Powell that I have found when I read about him is that he does what he says. So he has raised interest rates, so that one is in the books, so we know. So maybe, with our fingers crossed, that is going to be it for the end of the year, because as you know, your credit card rates keep going up. If you need a new car loan, that's going to go up. Everything is going up. But as a result of, or in tandem with all of this, we have our first U.S. Treasury downgrade since 2011. Now, I've talked on my show about how the United States raises capital, right? Raises money for our budget. And I've talked an extent about the different categories that are covered in the United States budget. And the thing is that one of the things I've talked about multiple times is that the interest on the debt that the United States pays is a line item in the budget. Now, a couple years ago, that was around 6%. I don't know what it is now, but it is a line item in the budget. So when interest rates are low, meaning that the Fed is keeping interest rates low, where they're keeping monetary policy loose, meaning that it's inexpensive to borrow money to buy a house or to buy a car or to buy a boat or something like that, then they're keeping policy loose. And what that also means is that they can issue brand new treasuries, United States treasuries, and they don't really have to pay people a lot to do it, to do it. So when I talked about bonds, when there's a treasury or there's a bond issue, what is basically happening is that when you are buying the bond from someone, you are financing whatever it is they need. So if I have Mel's yoga pants and I want to build a warehouse, I will either go to the bank and say, give me $1 million, or I can, under certain circumstances, issue a bond. And then you would go buy my bond for $1,000 and say it's a 10-year bond. And then I would pay you, 6%, so $60 every single year until the end of 10 years. And then I would give you back your $1,000 in your last interest payment, and we're done. Okay? Treasuries work very similar, except they're backed by the taxing authority of the United States government. And when interest rates are low and they issue new treasuries to raise capital because you're going to buy their treasuries and thus give them your money, they don't have to pay you a lot. But when the Fed raises interest rates, especially as aggressively as they have done last year, then what that means is every new issue that comes to the market, they have to issue it at a higher interest rate because they have to get people to come in and buy their bond. You feel what I'm saying? So we have that going on where the newer bond issues are coming out and they have to pay higher interest rate to get people in the door. Well, one of the things I've touched on multiple times is that the United States government has always, well, not always, besides one time prior, had a AAA rating. So for ratings for bonds and debt instruments, that is basically their credit score. So AAA is the highest you can get. There is only one other time that another rating agency downgraded the United States treasuries, and that was in 2011. And just recently, Tuesday of this week, Fitch downgraded the United States treasury from AAA to AA. Now, just so you guys understand, there's AAA, there's AA. There's AAA, AA plus, AA, AA minus, double B plus, double B minus, and then down it goes. Anything below a BBB is considered a shitty FICO score, and it's not considered investment grade, which means that there's going to be certain pension funds and companies who cannot buy any type of debt obligations that are rated less than investment grade. Okay, so just think about it as if you got shitty credit. First of all, you got to find somebody to lend you money, and then you're going to pay out the nose for it, right? It's the same thing. But this is a vanity thing for the United States, because when we have turmoil in the globe, there's what we call a flight to quality, meaning that people are terrified, 2008, and they rush to countries that are secure. They rush to debt obligations that are perceived as secure. The United States is a fan favorite globally in the event of a flight to quality. And it is also the basis and part of some of the fiat currencies that other countries are measuring their currency again. And we are also on a fiat currency. I've talked about that on previous shows. Okay. So it's a big deal. Our AAA rating is a big deal. Now, a drop to AA plus is really not that big a deal. I mean, we're still extremely high up, but of course, everybody's freaking out. And Janet Yellen, our Treasury Secretary, is saying that the data is outdated that they're using and saying that it's arbitrary. Well, it's not really arbitrary if you read the reason why Fitch downgraded us. So, the last time the United States Treasury was downgraded, it was in the midst of a financial turmoil. We were in a recession. recession, or yeah, it was the recession. I can't remember if it was a small recession or if it was around the Bush tax cuts. I'm getting all of it blended. When you've done this for so long, there's so many crises that come through the government. They all just fucking blend together. But S&P, so there's Fitch, Moody's, and then there's S&P. Those are the three major people who take the FICO scores of our U.S. Treasury, thus our U.S. government. And Fitch downgraded the United States kind of out of the blue, because right now the economists are still thinking that we're going to skirt a recession, and it looks like inflation, at least on some indicators, is starting to calm down. And Fitch was just like, yeah, fuck it, we're going to downgrade you guys. But their logic makes a lot of sense. And they cited a couple things. They cited the polarization in the political system, thus in our financial system, which I talk about this all the time, because Democrats are never 100% right and Republicans are never 100% right. But the way that our system has become, they are more concerned with getting elected than doing and working for the American people. So the left has went farther left, the right has went farther right. And they said there's too much polarization in the United States government, thus in fiscal policy. And we don't see an end in sight for this. So they didn't like that. They also mentioned very specifically the January 6th insurrection. Now, and depending on how you guys feel, you could take everything going on with Trump in this, whether you think that Trump is being railroaded and none of this is right, or if you think he's finally getting exactly what he deserves. The point is that this is historic in what is happening right now. And the charges that are against Trump are extremely serious and verging on treasonous. So regardless if Trump was a Democrat, that's a big deal. That's for America, who is, we pride ourselves on this, democracy and everything. That's a big deal. And the other thing that they cited is the debt ceiling debate, which we talked about in length on the show at the beginning of the year, and why this was so dangerous, and the fact that both sides use it as a posturing tool every single time it comes up. And I also talked about how the point of the debt ceiling is useless. There's no reason to have the debt ceiling anymore. None at all. But neither side, and this is why you should look at your political party. Whatever political party you align yourself with, just see that not everything they do is right? Because neither one of them will remove it, because it's a way to show, look what we're doing. We're fighting for our core beliefs, or we're doing whatever. But what they do every fucking time is that the market goes into turmoil and people get uncomfortable. And the people who are sitting in Congress fighting about the debt ceiling, none of this affects them. They're in the 1%, they're wealthy. But the 99% down here, we get affected by what goes on with them. And so Fitch said, hey, this increasing argument over the debt ceiling is a problem, you guys. So as I've reminded you, I'm going to remind you again so you can follow with me. There is a comprehensive budget that is passed by Congress where they know exactly how much money they are going to need to raise by issuing Treasury bonds. Everybody knows it. Republicans know it. Democrats know it. They know it. Then when the debt ceiling comes, which is outdated, they argue about how much money we can raise to pay our bills of something they've already approved. Okay, so Fitch was like, this is bullshit. And it is bullshit. So Fitch is like, fuck that, fuck you guys, we're going to downgrade you slightly. However, Fitch did say in their report that in order to get the AAA rating back from Fitch, they would need to look at severely overhauling the debt ceiling or completely eliminating it, which it needs to be eliminated, in my opinion. They also have concerns about GDP and our debt to GDP. So GDP, as I mentioned before, is gross domestic product. Gross domestic product, all countries have it. It is a measurement of what a country produces. Okay, so it's basically like how, are we rocking and rolling? Are we producing a lot of stuff, goods and services, or are we floundering right now? Simpsons floundering. You see what I'm saying? So the last debt ceiling debate, they've pushed it off to 2025 because this is what they've done for years now, decades even, where they just kick the can down the road, but they never address the real problem. And so they've said, look, you got to figure this the fuck out. And then on top of that, you need to figure out your debt to GDP, because we have been going round and round and round in circles, and our debt to our GDP is starting to get higher. And the reason why that's important is because that looks like maybe the United States won't be able to pay their treasury debts back, or maybe they will not have the fortitude politically to actually make that happen. Because during the debt ceiling debate, I explained to you that per our U.S. Constitution, you have to pay things on an even, like you can't select to pay this. Like if it's you could be like, well, I'm going to pay my house payment, but I'm not going to pay that credit card payment this month because things are tight. The United States government, per our Constitution, you can't. You either pay everything or you pay nothing. You can't prioritize anything, which is the reason why the debt ceiling debate is so dangerous. And Fitch is saying, look, we don't know if the politicians will either be able to pay, meaning that they'll have the balls to figure it the fuck out and pay it, or if you guys are going to be able to get your debt to income ratio in check, right? And so that was a huge deal in the fact that it was a downgrade, not that the downgrade itself was that much. However, could S&P follow suit? Could Moody's follow suit? Absolutely, they could. Will they? I don't know. I don't have an answer to that. And so that's what's going on with the downgrade. When I come back, I'm going to talk to you about why you should care and how that's going to affect your pocketbook. And I will catch up on chat. This is not a metal song, but I've played it before. It is literally one of my favorite songs. I absolutely love the guitar in it. God, I love that song so much. If you guys catch me on the right day, when I just need to purge, or I don't know, sometimes cry, or sometimes punch people, sometimes cry while I'm punching people, that song, I can put it on repeat and it just gets better and better to me. And it's I don't know, there's something about that song that I absolutely love so much. And so we got Kodak in the house. What's going on? How you doing? And I think I already said hi, hey to Analog, and of course CPL. So CPL pointed out exactly the fact that Janet Yellen was so butthurt that the United States treasuries got downgraded, being a former person on the Federal Treasury Committee, is kind of hilarious to me. Because the thing is that our government has been playing fuck games with our money for so long, to no detriment of their own, that yes, you absolutely should have been downgraded. And I completely agree. And he was mentioning about, I believe I hope it's he, CPL, let me know, was talking about how they nailed it. It's government, let's see let me read I think it's his exact quote. Basically, now I can't find it, of course. Fantastic. Oh, here we go. Nope. Yep, Fitch nailed it. Erosion of governance, 100%. We seem to think as Americans that we shouldn't, like we're impervious to political shifts, that we're impervious to bad politics, that somehow we're not going to be subject to any of that, and it's not going to trickle down and affect our money. And it absolutely does. Other countries' debt gets downgraded all the fucking time. But when it happens to America, we're like, what? We're all indignant. We're all upset. And do you know who we are? I mean, it's an arrogance that is palpable and disgusting, quite frankly, because what it makes us believe is that our parties can continue to play fuck games, and we're just going to keep rebounding out of it. And eventually, if this gets bad enough, could they downgrade the U.S. Treasuries below investment grade? Yes, they could. But do I think that's likely? Probably not at all. But the point is that it's moving in the wrong direction. And anytime our credit rating moves in the wrong direction, it means that it costs more money for our government to raise money, to pay for the shit that you want, whether it's defensive spending, whether it's to prevent homelessness, whether it's to fund education, whether it's to maybe upgrade the health systems, for Medicare and Medicaid or whatever. The point is that having a downgrade is not good. Now, do I think if S&P and Moody's followed suit and also downgraded the U.S. Treasuries by 2025, if they were still downgraded, if Fitch holds true to what they said, that, hey, look, we're not upgrading you until you figure the fucking debt ceiling out and stop being dicks, right? So until you do that, we're not going to upgrade you. So if S&P and Moody's did the same thing, it might send some type of signal. But do I think that such a small downgrade is a big enough impact to move the needle to change the partisanship that's dealing with our money and the debt ceiling debate every couple years in Congress? I absolutely don't, right? But maybe if everybody gets on board, then it would actually move the needle. Okay, so again, remember that every time the United States Fed, when they issue treasuries to raise money, the interest that they have to pay to the people who bought their bonds, that's a line item, just like it is when you're making your credit card payments. And you've seen, no doubt, that from last year, your credit card payments are continuing to increase because interest rates haven't continued to increase. The difference is that credit cards are variable and treasuries are fixed, meaning that once they issue the treasury, that is going to be the interest rate it's going to pay regardless of what interest rates are 3 years down the road or even 3 months down the road. But the point is that it gets more expensive, which means we have even less money. And I know I say this 1,000 times, but I want you guys to really keep remembering this, that 2/3 of our budget is already set in stone. 2/3 of the United States budget is already made up of entitlement programs, Medicare, Medicaid, Social Security. So we're not really working with a lot of margin, you guys. So having, and then out of that the third that's left over, 50% of that's automatically allotted to defense, which means that we're working with even a smaller portion, which means that we don't have a lot of wiggle room. We don't have a lot of discretionary income, you guys. So the thing is that when we are issuing treasury debts that we have to issue at higher interest rates, that's a big fucking deal. It's eating a bigger chunk of a very small portion of the pie. Okay? So with the Fed aggressively raising interest rates, we haven't really felt the effect of that yet. So we see now some of the indicators are telling us that inflation is starting to kind of calm down a little bit. But for people out there who are carrying any type of variable debt, what we see is that they are starting to feel the effects of months and months and months and months of higher credit card payments. And typically what happens is that when we go into a increasing rate environment, we see more defaults. We see more defaults on all types of loans. Now, not specifically mortgages as much, because now, especially since we moved away from the subprime sector, and now we're back into the traditional prime mortgages, which we're going to talk about here in a minute, then, and I just lost my train of thought because I was scanning my notes as I was talking. Fuck, I hate when I do that. Oh, more caffeine. So anyway, we see that there's typically more defaults when we're going into a higher spending. And then, of course, we still have to deal with the fact that as the United States continues to have the problem of the debt ceiling, and if the other ratings companies do follow suit, then, of course, that is going to have us fall in the global standing. And one of the things that has helped the United States is that when we have massive global downturns like 2008 that we had here in America, and then in 2009 that Europe experienced, people will usually come and they will buy United States treasuries, which means that our government has a good flow of money that continues to come in. And we have allies and we have non-allies, right? So we have some countries that would love nothing more than to see us have our fiscal health called into question so that they can use that as a means to continually kind of berate the West, all right? And this plays into bigger macroeconomics and bigger things, and we're not going to get too much into that, but just know that it will inevitably cost the United States more money with a downgrade to issue treasuries, but they 100% did it to themselves. So I would say we did it to ourselves, but we weren't the ones making the decisions. I guess if you get down to everybody's vote and who got into office, maybe we were the ones making the decisions, but we are not involved in the day-to-day Congress meetings and all of the debt ceiling posturing, okay? So as a result of the Treasury downgrade, we see that yields on treasuries have spiked. Now, I've explained this before, but I want to explain it to you again. If you hear Treasury yields jumped, that sounds good, right? That sounds like that's a good thing. Well, not really when you're talking about fixed income instruments. So think of a teeter-totter, and I talk about this in my book, and there's a diagram in there. Think of it as a teeter-totter. On one side, you have the value of the bond, because a bond treasuries, I'm using those terms interactive, okay? I'll just say treasuries, so since I am staying consistent. On one side of the teeter-totter, you have the value of the treasury. So let's say you buy a treasury for $1,000. Well, tomorrow, the treasury could be worth only $950. Okay, so your value is going to fluctuate. And then the next month, it could be worth $1,010. It depends on what the going interest rates are and how long the maturity is on your treasury. You don't need to understand all of that. Just know that just because you buy a treasury at $1,000 doesn't mean that the next day it's worth $1,000. That's what I'm trying to tell you. So on a teeter-totter, on the left-hand side, you have the value of the treasury, and on the right-hand side, you have the yield. So if you have one side, if you put your hands together and do like what I'm doing with a teeter-totter, if you have one side go down, one side goes up. So if value goes down, that means your yield is going up. And if yields go down, that means your value is going up. So let me put that into context that you guys can understand. If there's a massive sellout in treasuries because they don't like the way that the United States government is being run, they don't think the United States government can meet their financial obligations, which would be a huge deal, then we see people selling out of treasuries, which means that their value drops. So if you put your hands together again, boom, your value's dropping, means your yields are spiking, meaning that people are leaving the treasury sector and they have piled into the treasury sector previously because of the simple fact that at the time it was the only place to get interest yield. So why is this important? Silicon Valley Bank. Silicon Valley Bank. That was one of the things that collapsed that bank, is because they took on, and I did a whole show on this, couple shows, they took on a whole bunch of money during the run-up, and they needed to put it somewhere that they were allowed to put it that was considered safe, that was going to pay them a decent return, and they piled into treasuries. And then when when the interest rates started hiking, the treasuries that they had purchased, remember how I just gave you the example that $1,000 treasury today doesn't mean it's worth $1,000 tomorrow, started losing value. So they ended up taking a huge loss on their books, and then they tried to immediately do a capital raise, and people smelled blood in the water, and they within 48 hours, they collapsed the entire bank that had been around since the 80s. So this is why this is important. This is why you need to watch this stuff, because when you hear of a treasury, and this is what I've been warning about, if you hear about a treasury downgrade and then you see that treasury yields have spiked, that's not good. That means people are flying away from treasuries. And you know who's still holding a whole bunch of treasuries? Pension funds, mutual funds, private investors, ETFs. There's a lot of companies, there's a lot of investments out there that are still heavy in treasuries. And now what we see, because of this very mild downgrade, which is very mild on the surface, we see that treasury yields are spiking because people are leaving this sector. So not only does that make it harder for people to buy the new issues to raise capital for our government, but it also can have a fingerling effect running through the bank system. And when I talked about Silicon Valley Bank, and I talked about Silvergate, and I talked about First Republic, because I think it was February, March, and April, boom, boom, boom. We had 3 big ones go down I can never say the word go down. And anyway, we had 3 of them go down, just like that. And I talked about at that time about how many other banks in our banking system were holding treasuries and why that should be a concern of us. And now we have a downgrade. That's why you should be concerned, because of the simple fact. Will something as small as this lead to more banks going under? I don't know. I mean, you would think it's such a mild downgrade, maybe not. But we also saw Silicon Valley Bank go under in 48 hours. You guys, 48 hours. This was a bank with a fuck ton of money. 90, I think I told you, I think at the time, 94% of it was not FDIC insured, meaning that the people that had money in that bank were very, very, very wealthy. And it was a darling of the tech industry. Done like that. 48 hours. Boom. Run on the bank, collapsed. And the major thing, besides the way that they managed, which I also talked about, was the treasuries. So this is a big deal. This is a big deal. And like I touched on, if in the event that the treasuries are downgraded again to below eventually a BBB rating, which I think if that happens, we would be collapsed as a government and we'd all be bartering and fighting off a zombie apocalypse at that point, then we could be in the same situation as Greece, where Greece, I haven't checked them lately, but during when 2008 happened here, we gave our cold to Europe. And Greece lied to get in the European Union. We talked about that. And their debt was so shitty. Basically, when their government was trying to raise money and they were issuing their Greek bonds, their Greek treasuries, they had to pay people 7, 8, 9, 10, 11% for a government bond, which is ludicrous, right? And the reason why was because people were like, there's no fucking way you're going to pay us. And as I'm reflecting, I actually think it was higher than that. But the point is that could we go the way of Greece? I mean, probably not. But is it a possibility? Yes, because we're not impervious in America. We're not superior. We're not impervious. We have to handle our financial system with care. And that is the reason why you should care about a downgrade in the U.S. Treasuries by Fitch. And we'll see how the other two do if they're going to downgrade. I'm going to play a super quick song, get some water, and we're going to come back and we're talk about housing. And then I'm going to just do some speculation about how we could start fixing the housing market, which is not without its flaws. And then we're going to talk about housing kits, which are a big deal. And I think it would be an interesting thing to explore and all the goods and bads that go around that. So here is I'll Stick Around by the Foo Fighters. On the Lyrics Lovers Lounge show that I do Tuesdays at 5 p.m., I talk about lyrics and I play a lot of music from a lot of different genres. And of course, many of you probably know that song was a not so love letter to Courtney Love from Dave Grohl. And a lot of the lines in there about, how can it be that something to people believe you're rehearsed insanity, leave, just let me be. And then he says, I don't owe you anything, blah, blah, blah. And so that was literally in interviews, he has said that was a direct, basically, fuck you, get off my nuts to Courtney Love. And that was, for those of you, which all of us did, lived through Kurt Cobain's suicide, that was a big deal, especially living in Washington State at the time in Tacoma. It was a massive kind of thing. So let's talk about housing real quick, and we're going to start bringing this all back, and we're going to start talking about what that means, what all of this means. My headphones are super loud because I was rocking out. So I've talked before about how when the Fed raises interest rate, it affects prime. Well, it affects the Fed funds rate, which affects prime, which affects your borrowing, your car loans, your home loans, things like that. So I wanted to look and I said, okay, let me just see right now as far as housing, because we talk about housing a lot on this show. And my goal is not to upset you or feel defeated in any way. What I want to do is I want you guys to get financial context around a lot of these financial discussions that are happening in politics. I think we get hung up on this person's racist, or this party's racist, or this party only likes rich people, or this party only likes poor people. And I think that the true financial numbers get lost, and the middle Americans, we get washed away in the stream of bullshit because we don't really understand how all of this stuff they're talking about affects us. And of course, there's a lot of hot button issues that overshadow anything financially. And I've talked about some of them on finance is the other F word, like gun control and immigration, but we're not talking about those things today. Okay, so I was just like, let me just do some very quick research. So according to bankrate.com, if you were to buy a $350,000 house right now in zip code 89124, which it just occurred to me, I know that's in Nevada, but I have no idea. It just defaulted to that. So let me tell you what kind of, okay, so it's kind of mid-range Las Vegas. So it defaulted to zip code 89124, and I was like, yeah, sure, we'll go with that. So according to bankrate.com, if you were to get to purchase a house today for $350,000 in zip code 89124 and did a 30-year conventional mortgage, okay, so what that means is that you put down 20% of the purchase price of the home, you finance the remaining 80% over 30 years with a fixed payment and a fixed interest rate. That's what a 30-year conventional mortgage is, okay? If you buy a home but you don't put 20% down, that is considered not conventional. Okay, it still can be prime, but it's considered not conventional. I'll answer questions on that if you have them, but you don't need to follow all that right now. But that's a conventional mortgage. You would be expected to put down $70,000, which is 20% of the purchase price, and your payment would be $1,793 or an APR of 6.828%. Now, I've talked about APY and I've talked about APR. APY is annual percentage yield. So your interest rate on an account could be 3%, but your annual percentage yield might be 3.05 or 3.20 or something like that, because it's the compound of the interest compounding on itself. So an APY is larger than a rate on an account, the annual percentage yield, all right? APR works the same way. Your mortgage rate might be 6.5%, but your APR is actually 6.828% because that interest compounds on it too. So interest compounds for the good and for the bad of you in both ways. So in this example, based at bankrate.com, you can go there, check it out if you want to follow along. Zip code 89124 is where it defaulted for me. It would be $70,000 down payment, and it would be $1,793 a month with an APR of 6.828. Now, this is where it gets slightly interesting, and I understand, but this has always been one of my bone of contentions. Let's assume that everything was the same exact zip code, 30-year conventional mortgage, but you were going to buy a home for $300,000. Okay, not 350. You would be expected to put down 20% of 300,000, which would be $60,000. Again, 20% of the purchase price. Your payment would be $1,537, but your APR would be 6.859. So in the prior example, the house was $350,000. Your APR was 6.828. In this example, your purchase price is $300,000, your APR is 6.859 because they give you better interest rates the more you lend or the more you borrow. Now, they could say it's because they can buy the bonds to back up the mortgage and they can buy it in bulk and it's a lot better. But the point is that literally you get a cheaper interest rate if you borrow more money to buy a different house that is more expensive. And that doesn't make any sense to me. And I know that we're only talking about a very small percentage, but all of these things add up. And we see that this is another way that the people who are wealthy continue to get better interest rates, because if you're doing a jumbo mortgage, way cheaper. So if you're Beyonce and you and Jay-Z are out buying another house, the mortgage interest rate you get is going to be so much lower than anything in the current market because of the price of the house that you're buying, and of course because of the fact that you're Beyonce and Jay-Z and you have good provable income, etc., etc., etc. So I just want you guys to know about this stuff, and I'm not trying to frustrate you, but when it comes to voting on initiatives and when it comes to having a partisan party, this is where I tell you both of them are right at different times, right? But I don't care who's right. You know what I want? I want whatever party's in the White House not to fuck me. That's what I want. Okay? I don't give a damn if you're a Republican and you're doing right by me, or if you're a Democrat and you're doing right by me. Just don't fuck me and don't fuck the American people. That's what I'm saying. So I'm like, okay, so let's assume that you were able to set aside 10% a year to save for your home. That means in this instance, it would take you 8.8 years in order to have enough money to put the money down on the house. Now, a lot of you would say, yes, but I could probably save more than $6,000, or let me back up. So the average salary, sorry, I missed that part. The average salary in the United States currently is $67,521. So if you saved 10% of your money a year with this specific purpose to put down on a home, that would take you a little over 8 years in order to do it. Now, could you save more than 10% for your home each year? You absolutely could if you really tightened your belt. But remember that you have other ordinary savings that you're already saving for. So this is kind of like on top of all of your other savings. So this is what the millennial generation is experiencing right now, is that it's going to take them 5 to 10 years to save up enough money to put down on a home, assuming that interest rates are not going to continue to go higher, and assuming that the value of the house, thus the selling price of the house, is not going to increase, which we know it is, because it does, because that's what happens. That's what's been happening. So what's happening right now in the current market is there's people like me who have low interest rate mortgages who are not going to fucking leave. There's no reason to sell their houses because they're going to sell their house and then they're going to go buy a different house, which still hasn't come down far enough in price. And then they're going to pay 3-4% higher on their new mortgage than what they're paying now. So what that means is for people, and typically this is the tail end of the Xers and the millennial generation and maybe some of the oldest Gen Zs who are looking at going into the housing market, the supply is not there because people are holding on to their houses and or they're renting their houses. So even though they might need a bigger house, they're going to make it work because their mortgage is so fucking low, right? So what's happening in the housing market is that we're seeing there's people branching out now where they'll be like, hey, it's owner finance, where you can come in and you do the mortgage with me. So let's say my mortgage is 4.5%, and let's say I charge you 5.5%. You, the buyer of the home, is still getting a lower mortgage rate than you would be able to get from a bank, because I just told you what mortgage rates are going for right now. And then me as the homeowner, not only am I getting my mortgage obligation paid for, but I'm also getting a little bit extra and 1% of my pocket, which sounds fantastic on the surface. And it sounds like kumbaya, everybody's hugging everybody and all that stuff. However, the problem is that if you own a home at a low interest rate and you do this owner financing and somebody moves into your home and they are paying on the mortgage that you're giving them and they lose a job or they're just assholes and they decide not to pay you, then you are still on the hook for that mortgage obligation. You also have lost that 1% extra you're getting a month that you've probably come to rely on for this, that, or the other thing. And then you have to foreclose on them and get them out of your house, which is costly and which takes a lot of time. You remember in 2008 when everybody was, actually technically more 2009, the tail end of 2008 and 2009 when all the wave of foreclosures came, the reason why it took 6-8 months for people to be forced out of their home is because the bank had so many foreclosures and people walking away from mortgages that they couldn't keep up with them. So if you're an owner and you're financing somebody to buy your house, then that's you now. You're the one that's going to be responsible for that, and you're still on the original mortgage that you're covering. But we are seeing where people are trying to do this in order to provide more inventory for the housing market. And the reason why I talk so frequently about the housing market is because, like I've mentioned a gazillion times, for the 99%, your home is the biggest vehicle of generational wealth in a family. 401k is second, but the 401ks historically have not been able to keep up with what a purchased home could be depending on how long you've had it. Now, if you just bought the home and 5 years go by, 9 times out of 10, the 401k is going to be the beefiest part of your estate. However, when we're talking about generational wealth, typically generational wealth is established and passed in a family with real estate. So my feeling is if you want to buy a home and be a homeowner, then you should have the opportunity, period, regardless of color, economic standing, location. Then that infringes on personal asset growth, and then that gets a little weird. So we can't really go down that path, even though we will here in about 2 minutes. And so the thing is, and if you don't and you like to rent because you want somebody to come in and fix your shit, awesome. All I want you to do is have the choice. Have the choice to do whatever it is you want to do. And if you do have kids and it is important to you that you pass on any type of generational wealth, then it might behoove you to look at purchasing a home depending on your financial situation. So I'm not giving you advice because I don't know your financial situation. Okay. So I started thinking about it. I was like, what kind of ways could we maybe right size the housing market? So currently right now, if you put your house on the market, everybody's bidding on your house. Investors, owner-occupied, everybody, right? So if you have a house that's on the market for $300,000 and you have an owner-occupied and they're going to buy the home and live in it, then that they might put an offer in if, the market's hot of $305,000. But then you can have an investor come in and say, hey, look, we're going to give you $315,000 and we're not going to fuck around with any of the bullshit. We don't have to do closing cost. I got cash money check. So as a homeowner, it is very appealing for you to sell your house out for cash at $315,000, knowing that that person is going to put that real estate into an LLC and then rent out that forever, thus creating an income line for their family and their generations, but then potentially maybe robbing somebody else of doing the same. Now, that's how it is currently. Not only that, but it also skews the MLS, because when you're pulling up comps in a neighborhood, if you have a whole bunch of investors, so this happened in Las Vegas when a lot of people came from California during 2008. This was one of the reasons why we were the hardest hit real estate wise, is because they pulled out equities from their homes in California that had went just astronomically off the charts. They came here, they bought a whole bunch of rental properties, and then when the market ate shit, they walked from their rental properties because they didn't give a fuck about the rental properties. Their primary concern was their primary residence in the state of California, and that is the reason why we saw Florida, Arizona, and Las Vegas get their asses handed to them, right? So what happens is if somebody's trying to put their house on the market, maybe the house is only worth $300,000. But if you're surrounded by investors who are buying houses at $315,000, that means that the comps in the area are $315,000, which means that the selling price of the home comes out for $315,000, which means that for an owner-occupied person, you could actually be taking some people who would be able to maybe own their first home or own a home, and you're pricing them out of the market. So I was like, what happens if we just stop that? What happens if we just made all separate fish bowls? You know what I mean? Where like, look, I am going to sell my house as an owner-occupied, meaning that if you are not an owner-occupied person, you cannot bid on my house. Okay? Or fuck it, I'm open to everybody. I want the most money. I want the biggest amount of money. I'm going to take investors. I'm going to take owner-occupied. I'm going to take everybody, all takers. Or you can be like, you know what, investors only. Now, this comes down to, do you care about your neighborhood? Do you care about your neighbors? Is it important for you to have owner-occupied, et cetera, et cetera? Maybe, maybe not. But if you did that, you would separate out the MLS and the comps and you would start giving homeowners who want to actually buy and own a home for their kids and for themselves and for potentially something in retirement, you would give them a more level playing field. Now, would it cap the returns of the sellers of the house? It could, but they would have the choice. They would be able to say all takers, or they would be able to say owner occupied only. However, we see with tax law that if you own a home for 5 years, really to have it considered owner occupied, you really only need to have lived in the house for 2 consecutive years for tax purposes. So could people get around it? They absolutely could. All right. But do you know what kind of stink this would be raised if Congress told all of these big rental firms that, hey, you now have to swim in a different pond, and you can't be competing for typical owner-occupied people who have less income and less buying power, presumably, to get the house? I'm not saying it's not great, but I'm telling you that that argument sounds really strong to me, that it would give people who want to own a home the opportunity to own a home. You feel what I'm saying? Okay. So going to the next idea. And I have a whole bunch. I was just like spitballing yesterday when I was walking through all this. So I'm trying to catch up on my notes. And so we talked about investors. Okay. And one of the things you could look at doing is you could limit, and this is going to make a couple asses clench, because this is going to make my ass clench even saying it. You could limit the amount of property somebody is allowed to buy. And as a financial advisor, I was like, I don't like that at all, which is preposterous, because the whole point of us as Americans is that we should be able to get as much money as we can and have as much money as we can and own as much stuff as we're allowed to, and then you can have the argument, well, what happens if people are spendthrifts? And I'm not a spendthrift, and I've saved my money. And because of that, I own 5 homes now. You're going to punish me because I've saved my money and these jackasses hasn't saved their money or hasn't been responsible for the money. Why should I be responsible for their bad decisions? And it goes back to what I asked you on the Ukraine-Russian grain deal. Are we our brother's keeper? Where does the line happen between what we will be willing to do for other people just to help them out and give them a solid versus when it infringes on us? You see what I'm saying? So you could also make the time that's mandated in the homeowners longer. Okay, so it'd be like, okay, if you're going to buy this home as an owner, before you can put it on the market, you need to hold it for 10 years. You need to live in it for 10 years, which of course is also ludicrous, because what happens if the person has a medical emergency? What happens if they have a 2-bedroom home and they get in a car accident and lose both their legs? You're going to force them to stay in that home? You see what I'm saying? So there's a lot of moving parts. And so currently right now, if you were to buy to be considered a new homeowner, a new buyer, a new homeowner buyer, you have to have not purchased a primary residence within the last 2 years. Now, people can have a kid in 2 years and need to upgrade, right? So that makes sense. But also it's like, okay, really? Like, does that make sense to you that you just bought a brand new house 2 years ago, but if you just wait 2.5 years, then you can now requalify as a new home buyer and get better incentives? Does that make sense? That doesn't make any sense at all, right? So you could increase that time frame. Like I said, I get it. People lose limbs. People die. People have kids. They need to be forced to expand. People have long-term care triggering events. Like, I get all of that, okay? The other thing is, what if we put a cap on the increase of the value of that homes? Like, we just say, you know what? Real estate can only go up 5% a year, period, or 3% a year. And for you might, and again, that makes my ass pucker, because I'm like, what? How would you even control somebody's ability to get gain for themselves, right? However, we do that with bonds to a certain extent. You purchase the bond at 3%, and that's what you're getting. Now, could you sell it for higher than what you paid for it at any given time? You absolutely could. So in that aspect, you're not being capped. But we do see that there are certain growth caps that are built into different sectors. You guys follow what I'm saying? So these ideas, while they seem a little bit far-fetched, they don't seem too far-fetched. They can also simply cap new home creation at the source. So for all of these real estate development companies, these developers who are going out and who are, building homes, we cap it. Boom. This is the margin that you can charge over cost of goods to build this home, period. Your built-in margin is 30%. Meaning that once you've put everything into the home that needs to go into a home, your margin is 30%, bro. That's it. That's all you get. You don't get to keep raising and raising and raising, doing first tracks and second tracks and third tracks and fourth tracks and making the homes more expensive, because regardless if you're buying the fourth track, if you're building the fourth track home or the first track home, the cost of the lumber and copper and shit like that has not changed that much that we should see a 40% spike in the price of that home. Do you guys see what I'm saying? And 40% is a little exaggerated, but I'm trying to give you guys bigger examples so you can understand what I'm trying to explain. Okay, so then I'm like, you know what? We have 3D printers. Can we print homes? We can. And in Las Vegas, there is a nonprofit that is using ginormous 3D printers to build homes for veterans. And this comes back to our little tiny home conversation and our kits that we're going to talk about here in just a second. So I'm going to play let's see, do I have a short song in here? I don't. So I'm going to play the shortest song I have in here, and I'm going to come back and we're going to wrap back around to the housing kits, what that looks like, how that could actually help put more homeowners into the real estate market, even though it's a very non-traditional way, and how it would give a lot of other generations who are coming up behind us, because we've seen housing prices and the inflation that they've created. We can see that by little small changes of any variation of what I just explained to you, these are things that could be implemented to help bring housing into affordability for the modern American, to build generational wealth for their children and their family. You feel what I'm saying? So let me play. This is the shortest song I have. We're going to come back. We're going to talk about housing kits, and I'm going to wrap up and get some caffeine in my life and catch up on chat. Okay, let's wrap up this conversation of different potential fixes to our housing market. And when I'm talking about housing market, I'm not talking about having a roof over your head, right? I'm talking about owning property, owning an asset, real estate as an asset class, because even though I live in my home, I own my home. It is an asset class for me and my portfolio. So I came across an interesting article, and I was already going to talk about housing, and then this article came up in my stream, and I was like, holy shit, this is fucking amazing. I did not know this. So for my 80s babies who are in here, you may remember the Sears catalog. It was magic, okay? Every year, this big, thick motherfucking Sears catalog would come out in the mail, and it would have everything. Medical equipment, it would have Craftsman tools, would have bras, it would have every kind of toy you could possibly imagine, sports equipment, appliances, silverware, plates. It was the Amazon in magazine form, right? Honestly, if Sears had been birthed in a different time, they would be Amazon, because Sears is really the one who pioneered this whole shop by mail, right? Which is now shop on the internet. But one of the things they did from 1908 to 1940 is that they sold home kits. So much like you would go to IKEA and buy a dresser and build it, they sold you kits to build a home through their catalog. So basically you bought the land, you got a plumber, you got an electrician, and then you built your home from their kit, and then you put your house on your property and had your plumbers and electricians do all your shit, and you, sir and madam, just owned yourself a home. Okay? So this is nuts. So there are craftsmen there's a Craftsman home in Boulder, Colorado that was built in 1923 that is currently worth $1.1 million that was built from one of these Sears kits. So in 1923, this is the financial data they're giving in the article. In 1923, you could buy a house kit for $1,797, which was about a year's worth of salary. So you still had to save for it. It wasn't like, you were just flinging it out there and they were just giving away these kits for free. I mean, it was still costly at the time. So in 1923, you could buy a house kit for $1,797, which would be the equivalent with inflation today of about $32,000. So even if you could buy one of these kits and you had to buy the land and you had to get a plumber and get hooked up to municipalities and electricity, it would still come far less than what going housing rates are right now. And so I'm like, what the fuck happened to this, right? And so we see that back in the day, one of these kits was about an annual salary, where we see housing prices for us today are trending to 10 times annual salary. And that is what created the number in the previous example that I gave you, assuming that you were able to set aside 10% in additional savings on top of your normal savings to put down on a home. Okay, so in some cases, you could get kits for smaller homes for $146 in 1911, which would be the equivalent of $4,500 today. So they had pre-cut lumber, they had shingles for the roof, they had doors, they had windows, some of them had staircases, they had hardwood oak floors, they included nails, screws, and an instruction booklet. They were shipped by train, and you could build your own fucking house. Now, Amazon has something similar. Amazon has tiny house kits, but they are made of, first of all, their ratings are pretty awful, plus they are backlogged on order by 8 months or so, and they are considerably smaller. They are not considered to be as sturdy or as live worthy. And remember that, of course, your house would have to pass permits and it would have to pass zoning. I mean, there's a whole bunch of other stuff. So it's not like you're putting up an IKEA house, right? So, but they do have something similar on Amazon. And the thing is that it is not getting very good ratings and is not considered very stable. But Sears at the time was able to do this and make a profit on it and still make a house affordable for people who were doing it. Now, of course, there's a whole bunch of factors. Number one, lumber is more expensive. Copper is more expensive. Land is more expensive, right? You would have to make everything pretty cookie cutter in order for them to turn a consecutive profit, which would mean that you would have to have things like the pre-cut lumber where the size of the house always stays the same, right? So therefore you can, or maybe it always has the same floor. The living room is always the same size. It might have different amenities, but then you could use the same oak wood planks and they would be the same size. So you could cut them in mass and you could increase your profit margins in order to keep it viable, because like I said, in 1940, they stopped doing this, and I'm not really sure why they stopped doing this. But the thing is that we have developers who are charging exorbitant amount of money for building homes. And I talked about capping them. I talked about capping it at the builder, not at the buyer. So if I buy it and then it goes up by 40% and I sell my home at some point in the future, then I got that 40%. But the developer, the real estate developer, will be capped at 30%, right? And so you're saying, well, that doesn't seem fair. Well, it is fair because IPOs work the exact same way. If I'm a brand new company and I issue an initial public offering, which means that it's the first time I've taken my stock to market, if I list it at $15, and it's purchased at $15, and by the end of that trading day, it's worth $20, I, as the company who issued the stock, don't get the $20. I get the $15. You know what that is? You just fucking capped my return. So it is my responsibility as the company to do the due diligence to make sure that the $15 is a reasonable price. As a matter of fact, If I'm issuing an IPO, what I want to happen is I want to have it issued at $15 and then basically have it purchased at $15, then go down to $10 by the end of the day, because that means that I actually overpriced it slightly and I made more money. Good on me, right? So the thing is that we could price it. Now, during the Great Depression, Sears sold 75,000 homes. That's fucking nuts, you guys. That means 75,000 people who potentially did not have homes before during one of the worst economic downturns had a roof over their head. Now, the reason why this would be hard to implement with my cap and a lot of my other ideas is because real estate developers are publicly traded companies. That means that I own them, you own them in your 401k, you own them in mutual funds. All of us have a piece of the developer pie. And if you cap their potential return on their product that they sell, then you are also capping potential upgrade or returns for people like you and me and your next door neighbor, right? Which doesn't really sound very good. However, again, if you look in the instance of IPOs, it happens all the time. It happens all the time. All right. So on Amazon right now, they have a little build-it-yourself house of 1,290 square feet at the price of $125,900. Okay. So if you can... I'm looking at my notes here real quick because I'm getting ahead of myself because I start getting all upset, et cetera, et cetera. So if you were to buy this house, then it is not going to have the oak wood floorings, and it might not have cabinets in the sense of the cabinets you think. It could just be potentially the frame of the house. Maybe it's the outside of the frame, but all of the internal stuff you have to have somebody come in and you have to do. That's the difference between the Sears kits and the Amazon kits that we have today. Now, we see that people can argue with mobile homes that this happens a lot, that mobile homes could be the new replacement for the tiny homes or building out homes. However, when it comes to lending, mobile homes are considered personal property. They are not considered a home. They are not considered a fixed. And if, depending on the lender, if they're fixed, meaning that they don't have wheels and they're basically cemented into the foundation, or they're on a solid foundation, then they could be considered a fixed, and you could maybe get a better interest rate if you're borrowing money to buy a mobile home. But typically they're considered personal property, which means that they're going to have a higher interest rate than you just buying a home. However, they are cheaper and more affordable. And in 1926, about 70% of the people in America could buy these homes and build them themselves. Now, would it take some level of skill? Yes. Do I think I could build my own home? Probably not. But I'll tell you, there's a whole bunch of people I know that work in construction that if I bought one of these kits, if they still had them around today, that I could pay them a reasonable sum of money and they could build that shit for me, and it would still come in lower than what the going price is for any of the houses. So this is one of the things that I find so fascinating, that we had a solution. We've had a solution. We've done it in the past, but we're not doing it now. Or we're doing it now, but we're sacrificing size. So we're saying, hey, we're going to send you out kits to build your own home, but they got to be these tiny motherfucking homes, right? Which, tiny homes, the size of it doesn't matter to me. But the point is that what I'm telling you is that we've done it before, but we've sacrificed materials now. They've gotten more expensive as ratio to income than they were before. And your inferior materials and smaller. So what I'm telling you is that we can fucking do it. We can fucking do it. And all of these empty vacant lots that have weeds growing out through them in urban areas where people are caught in slums and they're paying rent that they're barely making for rundown, old, antiquated places, could they be in a position where they could buy one of these kits and get a tiny home and maybe go on one of these lots for all of these urban areas that are having, that land is just sitting there and not being used? Would that be better for the greater good? It absolutely would. But then you're infringing on the right of the person who owns the land to sell that to a commercial buyer who might be able to build a high rise on it. So the point is, I don't have all the answers, but that is a deep dive into the housing market. And that puts us right about at 7:30, which is where I typically try to cut off because I know this is a lot of financial information. I appreciate you guys for hanging out. Let me just check chat real quick before I bounce to make sure that... Oh, yeah. So Tabor, yes, the Sears catalog was amazing. So with that, I will be back on my regular schedule on Wednesday and Friday, 6 a.m. Pacific time. I don't know what I'll be talking about, but I'll be talking about something. And if you guys have questions or you guys want the references that I used in order to do the research for my show, feel free to email me at mel@financestheotherfword.com. I will pass on the links to you. And any combination of any of the things I just suggest, I will argue with you, would be a viable movement in the right direction to get housing affordability in the home of modern standard Americans. You know what I'm saying? So you guys have a great Friday, great weekend. I will be running around on your shows. I appreciate you guys for tuning in. Thank you for letting me have an audience. I thought maybe nobody would come back because I'd been off for 2 shows, but you did, and I love you for it. And with that, AMP, I am out this bitch.
Thanks for listening. If you like us, subscribe wherever you get your podcasts.